Welcome to Taking Stock for the week ending the 20th of March 2026. I'm Kien, Head of Research at Stock Doctor, and joining me today is our Senior Portfolio Manager, Matthew Swartz, to stream to you all things share market. Welcome aboard, Matt. Great to have you here again.
Great to be joining you too, Kane, despite it being a pretty tough week for our members.
Yeah, it's been quite a volatile week, especially for those gold stocks. But before we begin, just a reminder that the information we discuss today is of a generic nature and doesn't take into account your personal situation or needs. Remember, shares are volatile, so any past performance isn't an indicator of future performance. But Matt, it's been quite a volatile week, as you suggested, with central bank decisions coinciding with a sharp escalation in the Middle East. Starting locally, though, the RBA, they lifted rates again to 4.1%, which money markets largely predicted. And the message here is that inflation was already too high, and now the surge in oil prices with Brent pushing above 110. Now that adds further pressure. The RBA is trying to act early to prevent inflation becoming entrenched, even if that means slowing growth and increasing risks of a recession.
And in the US, it was the same hawkish type of tone. The Federal Reserve held rates steady, but did deliver a clear higher for longer message, as revealed from the dot plots that were released in tandem with the interest rate decision. Inflation is obviously proving a lot stickier than they had hoped for, and now the war is adding a fresh supply shock through energy markets. Strikes on key oil and LNG infrastructure, along with disruptions through the Strait of Hormuz, removing supply and pushing fuel costs a whole lot higher.
Yeah, definitely, Matt. And this combination, higher energy prices and also restrictive monetary policy, is quite a challenge for equity markets. It was also a challenge for gold during the week, which also sold off significantly. That seems to defy that mantra that inflation and geopolitical risks, it tends to be good for gold. But what's going on here, Matt?
Well, certainly not in the short term as it can. And the reason I think for the sell-off is because markets had been pricing in rate cuts. And when those expectations are pushed back, which they have been, the opportunity cost of holding gold has increased somewhat. And that's flowed through to the sell down across gold equities.
Yeah, definitely. So we're in this phase now where we're entering a more uncertain environment of escalating risks and also slowing economic growth. But rather than try to predict these kind of outcomes, it's better to focus on how you can prepare your portfolio for resilience, and that is remaining diversified across stocks and asset classes, owning those high quality businesses, and also taking advantage of opportunities when they arise, especially having some cash on the sidelines there. But turning our attention to a few star stock highlights for the week, especially during reporting season, a few of our members have been asking how these geopolitical risks are playing out for a company like Brambles. Now, they are a global supply chain logistics provider through their ship pallet network. While typically viewed as a defensive business, they're certainly not immune to the current environment. You've got rising oil prices that's flowing through to higher freight and transport costs, while disruptions across the Middle East, particularly around the Strait of Hormuz, it's delaying trade flows and increasing supply chain complexity.
Yeah, that's exactly right, King. And in the short term, that means high logistics costs and slower pallet circulation, particularly across consumer goods and beverages, which account for the majority of Brambles' revenue. And at the same time, rising input costs, including energy and materials, are putting pressure on their earnings margins.
And of course, there's also a demand element here as well. Slower trade flows across Europe and Asia that can reduce pallet volumes, while uncertainty may also lead to inventory destocking, as we saw, particularly, during that COVID period.
Yeah, and these risks are certainly ones we are monitoring quite closely here at Lincoln, and you can keep an eye on the earnings revisions to see how analysts are dealing with it. But more broadly, higher oil prices act as a tax on the global economy, impacting demand across most stocks and industries.
That's right, Matt. But Brambles, like most high quality businesses we do cover, they have several defensive levers to mitigate these risks. They've got a global footprint, which allows them to reroute supply chains, while their pricing power enables them to pass through cost inflation over time. Very strong cash flows and also automation and high profit margins that provides them with a buffer to navigate these conditions better than most. And this week, under the microscope, we're looking at Ridley Corp, an animal feed and fertilizer manufacturer that sits in the middle of the agricultural supply chain. Now, our analyst, Charlie Song, he spent some time during the week with management just trying to scrutinize the company. Now, the business produces stock feed for livestock and also water-dwelling animals, and more recently, fertilizers following their recent major acquisition. Because they support the food production, demand tends to be relatively stable, making them a more defensive exposure compared to other agricultural businesses.
Yeah, that's a can, and that's a key distinction, isn't it? Unlike farmers or commodity producers, Ridley has limited direct exposure to commodity price swings. Its scale provides both demand and cost advantages. Importantly, different segments do respond to seasonal conditions. For example, drier conditions increase supplementary feeding demand, while wetter periods support livestock conditions, helping to effectively smooth earnings over time.
Yeah, that's quite a defensive kind of business model there. But that said, margins are relatively low at around 4.5%, which can raise questions about downside risks in higher costs environments, particularly with the rising oil and logistics costs. But because Ridley operates in the middle of the supply chain, it's better insulated than most. Management has also shown discipline in exiting underperforming businesses and also recycling capital into higher return opportunities.
And as you pointed out, Kien, the major change in the Ridley story is that fertilizer acquisition. And early signs are encouraging with improved cost control and margin management already lifting its earnings. While the Middle East conflict has pushed up urea prices, management expects no material impact to financial year 2026. And looking ahead, return on equity is expected to improve to around 16% for financial year 27, with earnings growth forecast to exceed 20% over the next 2 years.
Yeah, that's very strong growth there, Matt. And from an income perspective, dividends are expected to rise to around 10.5 cents per share this financial year, up from 9.75 previously, supported by strong underlying free cash flow generation.
And in terms of valuation, it looks quite compelling. The stock trades on around 13 times forward earnings and sits at a discount to fair value based on analyst consensus. If management delivers on integration and margin expansion, that could present a really attractive buying opportunity, particularly given the company's defensive earnings profile and the improving growth outlook.
Now, following the sharp decline in Australian gold miners over the recent week, a key question for investors is, can gold miners still act as a hedge for your portfolio?
Very good question, particularly considering how hard it has been for investors in gold miners this week. But I think the short answer to that question, Ken, is yes, but it's certainly an imperfect type of hedge. So historically, physical gold has performed really well during periods of geopolitical uncertainty. Across major conflicts, gold prices have typically risen, but particularly when those events coincide with inflation and monetary easing.
That's right. But gold miners, on the other hand, behave quite differently. They provide that leverage exposure to the gold price, which means over longer periods, they can outperform, but with higher volatility. But in the short term, though, they still equities. So they're sensitive to interest rates, costs, and also market sentiment, which has been very weak over the last couple of weeks.
Yeah, that's exactly right. And higher real interest rates and rising costs, particularly diesel here, on account of what's happening in the Middle East, are weighing on margin expectations, even as the geopolitical backdrop remains supportive for gold.
Right, and historically, though, gold miners they tend to outperform in subsequent trend periods rather than during the initial shock, and hence it's best to invest in the higher quality ones, those with lower costs, growing production, and with high quality assets, especially those in our star stock universe.
Totally agree. So the key takeaway here is that gold bullion is the cleaner hedge, while gold miners are a higher risk cyclical way to gain exposure to the rising gold price environment.
Especially over the longer term. But for investors, it really comes down to your objective. Are you seeking protection during the volatility or total return over the next 3 to 5 years? Because gold miners can do both, but not at the same time. And that brings us to the end of this week's episode of Taking Stock. If you have any friends or family who you believe would benefit from Stock Doctor, please feel free to share our referral link. We continue to grow and improve thanks to your support. And Matt, thanks for joining us today.
No, thanks for having me, and we look forward to speaking with you again next week.
And until next time, have a happy, healthy, and prosperous week ahead.